Hello there, Mike Molina here. Well, of course, the most often asked question I get is, what are interest rates and when are they going to come down? And in this short video, I'm going to touch on two key things that I think will be a little bit of prognostication for the future of rates that you can comfortably rely on. Because especially if you bought a house and I did your loan in late 2022, 23, or even this year, 2024, you have a rate that's probably unusually high, and you have a free refinance coming up with me, and I'm going to keep my eye on that and contact you when it seems like a good time to execute on that. So I'm going to take a few minutes to go over these two bits of key information. And if you have any questions, please don't hesitate to contact me after. Okay, here we go. So the first thing we need to talk about is the upcoming presidential elections and how presidential elections in general have affected the housing market and specifically interest rates. So historically, of the last 11 presidential elections, in eight out of the 11, interest rates actually dropped somewhere around a quarter to maybe not quite a half on average out of the last 11 elections. Not only that, what we've seen is that as interest rates have come down, house prices and values have gone up and housing activity has gone up. So we should see after the presidential election, regardless of who wins, a decrease in rates as well as an increase in housing activity and home values. So that is all good news. Now, the other key point of data that I want to talk about is the relationship between inflation and mortgage rates. And this is probably the most important thing. The historical analysis of presidential elections is important, and history does tend to be a good predictor of the future, but something you can absolutely rely on 100% of the time is that without exception, as long as you've measured it, interest rates follow inflation. And this chart goes all the way back to 1968. And as you can see, without exception, as inflation moves, so too rates follow. In July of 2022, inflation spiked and hit a 40-year high of 9%. Now, since then, we've come down quite a bit, and it looks like we're continuing to come down, but we haven't really been able to make any significant headways. It's kind of been a slow trickle. In June of this year, 2024, we had an inflation report that came out, and it was way better than expected. And it looks like that trend is going to continue. And why is that? Well, there's many things that are measured in these inflation reports, and a lot of them are called lagging indicators, meaning the event that's included in the report happened, but it happened like a year ago and it's just now manifesting in the results in the report. One of the probably the most important and most significant impactful, makes up 45% of the inflation report, is shelter. And shelter has been coming down consistently for quite a while, but it just started to reflect in the June inflation report. And we can measure shelter separately. Why does it take so long to show in the inflation reports? I don't know. That's a really good question. But the Fed has its way of doing things, and it is what it is. So, I'm just reporting it. All right. So we know that inflation has the cost of shelter has come down significantly over the past year. And now moving forward, every month, we should see that reflected in the inflation report. And as the inflation reports come out more and more favorable, then mortgage rates will follow suit for sure, because it's always been that way. And it always will be that way as long as our economy is set up the way it is. So how does that impact you? Well, I'm sure you've heard on the news, the Fed is going to lower rates, or the Fed is going to raise rates, or will the Federal Reserve lower rates? Well, what rate are they raising and or lowering? They're not lowering or raising mortgage rates. They don't have anything to do with that directly. They are raising or lowering something called the Fed funds rate. And that Fed funds rate is the basis for all other lending in the country. Okay. And so all other rates tend to follow that. I mean, at least the direction of that. Now, right now, the Fed funds rate is 5.5. Okay. And to that Fed funds rate, that base rate, banks add 3%, and that becomes the prime rate, which is 8.5%. And the prime rate is the basis for all home equity lending. So if I've done a home equity line of credit for you, for example, your home equity line of credit was based off of the prime rate, which currently is 8.5. And then depending on how much you borrowed, what your credit score was, et cetera, there was a margin added to that. And the two together become your home equity line interest rate. So as the Fed starts to lower the Fed funds rate, the interest rates on your home equity line of credit is going to come down as well. However much the Federal Reserve lowers the Fed funds rate, that is exactly how much the interest rate on your home equity line of credit will come down. Well, do we know that the Fed is going to lower rates? Well, you can't know anything for certain, but we can certainly know things to within a very small margin of error. Now, this right here is something called FedWatch, and it's done by a group called CME Group. And what they do, all they do is run analyses of and predictors of what the federal is going to do and when they're going to do it. So there's a lot of information here. It's really not hard to read. I'm going to walk you through. It'll take you just 1 minute. So right here, these are all the Fed funds meeting right here. January 31st, September, November, December, all this year, and then going through until July of 2025. Now, these two charts are mostly more or less the same. This is breaking it out in more detail. This is just an aggregate, but it's the same data. So right here, you can see right now we're you don't see the decimal point, but it's there. So we're at 5.5, okay, 5.5. So this is the 5.25 to 5.5 range. This is where we currently are. And in the upcoming July 31st meeting, which will have probably already happened by the time you see this video, nobody thinks that they're going to change it. They're going to leave it right where it is. 93.3% chance they're going to leave it right where it is. At least that's the current consensus. Okay, a small amount, there's a small chance they'll lower it a quarter or so, 6.7%, but there's not much consensus on that. Now, getting into the next month, September, 91.4% believe that, and these are experts that do this sort of thing. This is not like a public poll of people. These are people that are in the know, right? So 91.4% chance that the Federal Reserve is going to lower at least a quarter, possibly even 0.5%. And you can see that trend continues on significantly all the way through July of next year. So you can see by July of next year that there's a 22% chance that we'll be at 3.5, a 32% chance that we'll be at 3.75, and a 25% chance that we'll be at 4%. So if you look down here at the aggregate, just to sum it up more simply, there's a 100% chance we'll be at 4%, minimum, maybe lower, but at least 4%. So we know almost surely that we know that rates are going to come down, and they're going to come down pretty significantly. And by July of next year, we'll be down to at least 4%, maybe even lower than that for the Fed funds rate. That doesn't mean that mortgage rates are going to be 4%. That means the Fed funds rates are going to be 4%, which means that mortgage rates will, if they follow the general, spread between the Fed funds rate and what mortgage rates tend to be, you're probably looking at an interest rate somewhere in the high 4s or the low 5s. It's going to be a significant improvement over where we are. And that's when your free refinance comes in. Now, if you can't wait that long, because right now, Americans are at an all-time high on their consumer debt. They have more consumer debt on their credit cards they've had in pretty much all of history. But the good news is they also have more equity in their homes than all of history ever. Like literally, they've never had more equity than they have right now. That's why the foreclosure rate is so incredibly low, because people still have good credit. They have a ton of equity. They're not going to lose it, and they're holding on to it. If you need relief, if you need to tap into that, then the free refinance standing aside, we can help you with consolidate your bills. It's not always about interest rate, okay? And maybe that means refinancing the whole loan. Maybe that means tacking on a home equity line of credit or a home equity loan, or maybe that means redoing the home equity line of credit that we've already done to do a new one that's at a lower margin. Because even though your home equity line rate will come down as the Fed lowers interest rates, the home equity lenders that do those loans will also be improving on the margins, which will also have a positive impact on interest rates. And the margin is assigned when you close on your home equity line and can't be changed. But if you refinance it, you can get a lower margin. So if you have questions about any of that, if you want to talk about debt consolidation, just remember, no matter what your concern is about when it's going to happen, I am watching this for you. So I did your loan, and if you're watching this, then I did. Then I've got everybody, all my clients, all of them, and with alerts and triggers set off when rates reach a certain level for each and individual client. So I'll be reaching out to you to make sure that we refinance you at an optimal time. It's going to be completely free, no fees at all. Just get your lower rate. Here you go. And thank you very much. So that's it for me. Just remember, you're always welcome to call me anytime. I love taking your phone calls. I love talking with you. No special appointment needed. If you want to talk about debt consolidation or the upcoming refinance, or even more bigger, deeper dive into interest rates and what the market's doing, etc., I'm happy to talk that up anytime. Please don't hesitate to call me anytime. I'd love to talk with you. Otherwise, thank you so much. Have a wonderful day, and we'll talk with you soon. Take care.